case study of CGA. Last class we discussed one case study as a model case study. Same way today we will discuss another model case study. We see the case study 2 here. Look here. Requirement and marks allocation is saying here. This way you can see that type of chart in also in institute case study paper. This way they summarize this way. So what is the requirement and how the marks distribute, totally 100 marks. Here requirement, that means here 5 requirements with the executive summary also. So marks of executive summary is 15 marks and others this way can be segregate. So here also in this case study, just a model case study, recent appointment of financial consultant. So as we discussed previously, who am I who are going for writing the case study? The position have to identify first. So at this moment, appointed recently finance consultant. So your role is you are the finance consultant. You have to ask by name to prepare a brief report for him in which you critically evaluate the tax proposal. MMA is one proposal within the question. Should acquire 3 expert PLC, another company, for 60 million based on the project given to you. By that, justify your answer and establish the valuation and using the following method. For example, here CAPM, weighted average cost of capital, FCMA, DCF sale, etc. Critically appraise the risks associated with the companies and advise MMAs to key advantage of associating the acquiring and that business, the acquisition. And there is a concept of corporate finance called agency theory. We know it, and that is acquire. Owner would acquire understanding the later. Analyze the issue of agency theory. Appearing the summary currency risks, you have to critically analyze how the company effectively manage the currency risks. So this is the all requirements and marks distribution. And if we go for exhibit here within this case study, here about the FIR Supreme PLC described here, and the shareholding position of the company, and also the board of directors. Who are the board of directors, their qualification and age of, and also association of that company, and a statement of profit and loss, comparison income, and also giving here the statement of position of another company. So projected statement, profit and loss for that company, projected 2 or 3 years projected within, we will see it, and projected statement of financial position and other relevant information within this exhibit. Total here 9 exhibits. So if we see exhibit number 1, we are saying the, as discussed here, about the FIR Supreme. So discussing the company here. FIR Supreme PLC is one of the most successful waste management companies and is involved in the many key areas of waste management, including recycling and collection of the disposal of the household, commercial, construction and demolition waste. So is the waste management company. Is the fundamental is waste management company. One of the one is waste management company. The company has growing significantly over the past 4 to 5 years. So the growing strategy, that means is growing 4 to 5 years, they must grow. Some of the main reasons for the growing of the company include the recent demographic change. That's, we know the demographic change that peoples of the country which have brought substantial extra demand for the company's service. The privatization of the waste collection service by the local authority and the fact that many local authorities have privatized waste disposal service. FS Supreme operate the mainly of the greater metropolitan area. Approximately 40% of the population lives there. So, and the company is founded by MMEs in 1997. Prior to studying the waste business, had owned very successful transport business. So the owner of that waste management company, they have the proved record of previous successful transport business he did, and now started another company, waste management company. He decided to move into the waste sector as saw huge potential of market significant profit. That's why they run the business this way. MMS also knew from the transport company and his dealings with the local government that allocate authority were starting the move of the. So it is the fundamental things is saying here. Initially he employed 12 staff and some truck or lorry for carrying the wastage. And at the turn of the century, in order to attain substantial capital, he decided to incorporate 2001 in the initial IPO in November of this year. Also is now the listed company. This raised substantial capital and now he had 60 weight collection truck or lorry. Now employees is 240, but they started only 12. Now 240 staffs engaged here, and the enterprise value 31st December was 450 million USD. So this is the company's background is here. We have to read it carefully. All describing here. So now the shareholding position of that company. So the real owner, he's owned the 35% shareholding, and from another company they holding 20%, another fund complete holding 15%, another fund 15%, his wife 5%, one of his son now running the business, he also take the 5%, and his daughter taking the 5%. Total 100% is here. So here the board composition of the company. So MMA is now the chairman. He's the founder of the company. His son is the finance director from 1998. Also, he also taking the board secretary job also doing. His daughter is a HR director since 2020. His wife is the CEO of 1997, though he is a non-executive chairperson. Another the representative of that fund and company, there are different types of board of directors is engaging here. So this is the board of directors total structure. And though it is a listed company, so corporate governance is using here, implementing here. The board met average 12 meeting per year. And also we know in our country we have the rules of as per the Companies Act 1994. At least every 3 months board meeting should be done, because we know there are different types of company, so they are not taking the board meeting, but as per the company's law we have to take the board meeting regular basis, and sometimes it can be more. So based on the company's work volume, the board meeting can be change, number can be changed. So this one, and Exhibit 4 says the situation. Why we are doing here? MMS had the meeting of Munim, who is the Director of Finance, early January, asked him to contact another company to taking the profit and loss of M3 Expert PLC. Monem tells MMS that the company do not produce profit and loss account and balance sheet anymore. That means another company. They now produce a statement of profit and loss account and comprehensive income statement of financial position. A tax financial account sent Mr. Monem. The information he was seeking in this information is set out the following exhibit. Exhibit 5, we are saying that the last 2 years statement of profit and loss account and comprehensive income, and for the year 31st December, ended 31st December, and exhibit here saying that the last 2 years statement of financial position. So exhibit 7, 4 years projected statement. That was the requirement of Mr. Monim, finance director. So now exhibit 5. So here a statement of profit and loss and comprehensive income for Estate M3 Expert Limited. Here figure of 19 and figure of 20. So here exhibit 6 is saying that a statement of financial position, same way 2019 and 2020, and now the projected exhibit 6. So a statement of profit and loss other comprehensive income of Estate M3 Expert for the year 31st December is the project for the next year. It can be we can change it maybe 22, 23 or 24 and 25, because now 21 is going on. So projected here a statement of profit and loss and other comprehensive income for the year 22, 23, 24, 25. Here sale volume, operating expense, the expected operating expense, operating income, interest, profit before tax, saying look here, profit before tax, taxation, net profit after tax, dividend and retained earnings. Same way the here financial position, we know it's the balance sheet also. So same way that would be again, it would be 22, 23, 24 and 25 also. So here fixed asset, total fixed asset, net current asset, operating asset, cash, you are adding net asset is this one, and shareholders equity as well as debt also, total financing this equivalent. So this is the financial position. Now the other relevant information of that company. So other relevant information is that Monim is somewhat connected with the carrying out of the analysis. MMEs, as they know, they will require deep understanding the many strategic corporate financial issue, including the estimation of corporate cost, etc. So that type of they are analyzing and working with the weighted average cost of capital, CAPM, free cash flow. We know that what is free cash flow. We know the cash flow. Cash flow is, we know the receive and payment, and we know the as per the International Accounting Standard 7, we are preparing the cash flow statement, and cash flow has the 3 items, that means 3 activities. So, operating activities, investing activities and financing activities. The same way we can calculate cash flow in 2 ways. One is direct method, another is indirect method. So direct method is that we know when we directly operating activities inflow outflow calculated directly, it is the direct method. And indirect method is saying that when taking the balance of profit and loss account They start from the profit and loss account and then adjust the other thing. This is the indirect method, and only this method is very only operating activity. Other activities is the same for both methods. So free cash flow is that we know when you have the commitment, you have the commitment for fixed asset and other expenses. That commitment, if deduct from the cash flow, is called the free cash flow. So no obligation of that cash is called the free cash flow. So free cash flow and determining the enterprise value business using discounted DCF analysis, discounted cash flow analysis. And the last is an independent financial consultant has ascertained the following information in the relation with the tax business. And previously, the appointed consultant, they said that the information taken from that that report also. So here, risk-free rate of interest, saying that 0.175 for 1% of 1%, and the interest rate of the stake debt expected to the remain constant for the 4 years period of 3.75. Stake of paying corporate tax 12% minimum tax, and this is the expected to continue for the next 4 years. So tax rate is here this less tax 12.5% for next 4 years also. So the market risk premium is 5.75% and also beta expected to 0.95. So we know what is beta, and beta is the calculation the market risk, systematic and unsystematic, and beta can be 1, beta can be more than 1, beta can be less than 1. So when it says that beta is more less than 1, it's saying that the instrument is taking profit, but overall market is volatile. Or we can say another way, the market is taking profit, but the instrument is not losing its value. So beta can be this type of beta. We know the beta equal to 1 or more than 1, less than 1, etc. So this is the individual consulting information. So this is the case study as a model case study. So if we go for the solution here, look here. First we have to take the executive summary is the front page. So when we start, so 1 or 2 pages we have to keep for the summary, executive summary, because this executive summary comes from the total overall result of other working. So we have to keep 2 pages for the executive summary in the front side. So this is the number 1 answer. So we'll see it later on. Now, as per the requirement 2 or B, establish the cost of equity by using CAPM formula as saying there. So CAPM formula we know, capital asset pricing model we know, here equal to risk-free rate of return plus beta multiplied by market risk minus risk-free rate of return. Sometimes this market risk minus risk-free rate of return is equivalent called the risk premium. That's why here in the question saying that risk premium. This risk premium is meaning that market risk minus risk-free rate of return equal to risk premium. We can say this thing. If we just put that data given in the situation, extra data, we can calculate easily here. So risk-free rate of return 0.175, and here beta saying 0.95, and market risk minus risk-free rate of return, that means risk premium 5.75, Putting the data here, we can find 5.64% is the cost of equity. Cost of equity in this case 5.64%. So doing that, so here establishing the cost of debt. How much cost of debt? So market value of equity 50 fully, because all data within the question. Yeah, look here. Market value equity 50, value of debt 6, value of the company 56. So equity divided by value. So total value at 56. If equity is 50, this 50, that means 50%. So it's come this one. And debt divided by total value, then comes 0.107143. So cost of debt is here calculating 3.75%. So same way, here we weighted average cost of capital. Here we receive the cost of equity and now the cost of debt. So we have to calculate the weighted average cost of capital. So weighted average cost of capital, we calculate here this 5.06%, and also you can say just 5%, rounding up, just 5% is cost of weighted average cost of capital. So now establish, see, is all should be, so establish the free cash flow from the project finance. So here calculating here, calculate this one. I will giving you the sheet also. So just do it in your working paper. Establish enterprise value calculation. So and terminal value calculation. After calculating that, we will get the terminal value. This one 55,160. And now the answer C. C, that means here, say the advise MMAs on the key advantage, disadvantage associated with the acquiring that stakes business. The advantage, disadvantage associated with the potential acquisition of the a department of many factors, including the acquired company's short-term and long-term strategy. Also factors such as the market environment, variation of the business culture, acquisition cost, and change of financial power, etc. surrounding the business acquired are key issue for the taken on board. So board will decide how the following are the sum of the advantage of the potential acquisition. So advantages are MMA would be able to enter the new market, that is new market, and that would not otherwise be in the which could yield more profit. That means after entering the new market can be achieve more profit through the waste management sector. And MMS could bring his expertise of running the large waste enterprise and decide to share resource, etc. That types of just positive thing, advantage. And there is also a possibility of a financial advantages for MMEs by acquiring a corporation of relation to the potential use of tax shade and tax benefit. And what would be the disadvantage? Disadvantage associated with some of the key personnel from the company can go to join another company, and some key personnel from the company leave as a consequence of the acquisition. The potential loss can be happen. An increase of the cost might result their delay of the employees to key personnel for the new venture. MMS decide to bring a staff from his waste management business into the new workforce, facilitate the internal composition and also push it, etc. can be different things, because the owner want to bring workforce from his country but after acquisition the new company. So key personnel who are within the company that company is going for acquiring, they can leave the job. Also, they can terminate it. That is the disadvantages associated with this taken over. And now agency theory examines the conflict of interest between people with different interests in the same company. Key components, key example include the conflict between the shareholder and manager. So now what is the agency? Agency, that means manager is agency. Manager wants more salary, more benefit. Owner is agency. Owner wants more dividend. And employee same way, the agency, they want more salary. Stakeholders, creditors, also agency, they want timely their disbursement, timely their money, etc. That type of agency. So this agency theory, here some conflict arise. So here some, if principal, that means owner, agent, that means our management can be, and conflict this way. If manager or management wants more salary, more benefit, then profit would be less. And if profit less, then dividend would be less. So owners always want more dividend from their investment. So that's why here conflict arises. This sometimes is called the agency theory, and that theory also can be agency cost also. So here the ration to the potential acquisition of M3 expert agency theory could apply between MMAs and his management team and the shareholder, depending if it is more share capital to fund the new venture that debt capital. It also depends on what percentage of the share capital. If MMAs is not the majority shareholder in the new venture, then he could be the agent. So etc. is the agency. So here we know the agency cost. This is the agency cost. Agency cost, look here. Bonding cost, cost spent by the agent to the align with the interest between the principal, shareholder and managers. And monitoring cost plus residual cost, also total makes the agency cost. And there are three major types of agency cost. One is expenditure to monitor the management activity, such as audit cost, etc. is the agency cost. Expenditure to structure the organization is a way desirable managerial behavior, such as appointing outside members to the board for the board of directors, restricted the companies, etc. is agency cost. Opportunity cost also is an agency cost here. So if MMM is not the majority shareholder in the new company, it is quite possible that the above types of cost would be exit. So in the acquisition goes ahead, MMS receive the potential conflict between the agency. So this is that means here they try to elevate the problems in relevant to constructive dialogue surrounding dividends being paid out, dividend being retained for future capital investment purpose to grow the business, etc. This way can be resolved with the others. So answer C, currency risk. It's also answer E. One of the primary currency risks facing, because they are going for divert their business different countries. Some are European Union, some are Asia. So European Union, the currency is euro, and Asia is in Bangladesh is Bangladeshi taka, and India is rupee, and different types of here currency. So currency risks also for when divert the money or when send the money to one country to another country, they can be currency. We have the currency risks, conversion risks, etc. So one of the primary currency risks facing MMA's company, he's decided to buy a stake M3 expert, assume given him that there has been a proper analysis carrying out the qualification of the business exposure of any potential change in the currency as a consequence of inflation, etc., and qualifying the exposure with the stake cost of the revenue in order to establish the exposure the currency could have, and also the significant amount of their supplier from the countries and the involved in the euro currency have to pay the through the euro currency at pound and buy then the euro. So here the conversion or currency risks when the company is exporting the recyclable product to Europe, China, that the relation with the financial goods and exporter, that type also currency problem is here. Potential currency risks. So have to manage the risks, and how manage? Manage from the dual invoice also, as a currency buying significant amount of material outside the country. So this way there are dual currency forward contract can be manage the currency risks. Also foreign currency account if maintained then can be risks minimized by this way. So this is the total answer is here as per the we are going hurry because you have to do this calculation in your working paper. So now one case study just for understanding.